Welcome to lecture 21 of Financial Risk Management, and we are going to explore the determinants of option pricing in this lecture. Moving towards the contents, previously we explored the model of put-call parity that can be used to find the premium of call or the put option. But there are some shortcomings in that put-call parity model, and one of them is quite obvious, and that is if we saw the model S naught plus P should be equal to C naught plus the present value of the exercise price. So we need to have three elements to find the value of the missing element. So how would we find the premium of put if we wanted to find the premium of call? Where would this premium come from? Or if we wanted to find the premium of put, how would we find the premium of call? Because we need three values for this model to work. One of this is the shortcoming, and the second is that there are certain factors that affect the price of the option, the premium of the option. And this model do not take those factors into account. So first we are going to understand what are those factors that would affect premium. I mean, why a premium of a certain option should be higher, why the premium of another option should be lower. What are those factors, what are those determinants that affects the premium of the option. And once we have determined, then there is another model, an advanced model, which is called Black-Scholes model, and this model uses all these determinants to find the intrinsic value of or the premium of the option. And this is more advanced, more superior models compared to the put-call parity model. So starting with the determinants, the first determinant is the exercise price. An increase in exercise price reduces the value of the call option and increases the value of put option. Now, let me explain this with an example. Consider two identical call options. These two options are similar in all aspects. They have the same underlying asset, the same maturity, etc. One with the only thing that is different is the exercise price. One I have the exercise price of 60 and then I have exercise price of 50. Which option would have more value? Now, first thing, to find the value, the formula is ST minus K. Basically, this is the, if you remember the formula of long call, it was maximum of 0, ST minus K. This portion gives us the value of the call option. Okay, so as K increases, the value of this call option would decrease. Imagine if ST is 100 and K is 50, then the value would be 50. If again ST is 100 but the K is 60, the exercise price is 60, the value would decrease. So this is what this the sentence is describing. An increase in exercise price reduces the value of the call option, and if the value of that option decreases, then would you pay a higher premium for a lower valued option or lower premium for this option? I mean, which option would you would have a higher premium? Obviously the one having a higher value, so this would have a higher premium as compared to this one. So what I mean to explain is that one of the factors that commands, that drives the premium is the exercise price. The higher the exercise price, the higher would be the value of the call option. This is just for the call option. The higher the exercise price, the lower would be the value of the call option. What about the put option? If you remember, the value of put option can be calculated by K minus ST, and this comes from the formula of a long put which is maximum 0 comma k minus xt, st, sorry. This part is used to find the value. So again, taking the previous example, if st is 100 and k is 50, we get the value of minus 50. And if k is 60, we get the value of minus 40. So which option is having a higher value? Obviously this minus 40 is having a higher value. Minus 40 is greater than minus 50. So as k increases, the value of put option increases. So if I sum it up, if exercise price increases, the value of call option would decrease, but the value of put option would increase. If their values, if the value of call option would decrease, its premium would decrease with the increase in exercise price. And the put option, if the exercise price increases, the value of put option would increase and its premium would also increase. So there is a positive relationship between the exercise price and the premium of put option, and there is a negative relationship between the exercise price and the value of or the premium of the call option. I would sum this up in the end of this lecture. Now coming to our second factor, which is expiration date. What effect would expiration date have on the premium of the options? Would the premium increase with the increase in expiration date, or would it decrease? So one thing, the higher the maturity, the higher would be the value of the option. I have written call option, but irrespective of whether it is a call option or put option, the value of the option would increase. Now why is that so? The reason is that option holder would have more time to exercise the option, and there is higher probability of profit for option holder and loss for option writer, right? You can ignore this aspect if you are getting confused, but just understand this aspect. When the time lengthens, when the expiration time is higher, there is chances that the price would either increase or decrease, giving a chance for the option holder, whether it is a call option holder or put option holder, to book profit from that option, from that position. So imagine that it is an American option and we can exercise it before the maturity. Then if the maturity is say just 3 months, then this option holder would lose this increase in price or decrease in price. But let's just say if the maturity is 1 year for this option, then there is a higher chance that this increase rally or the decrease in price would be profitable for this option holder. So the idea is that the higher the expiration time, the longer the maturity, the higher would be the premium of that option. Our third determinant is stock price. As the stock price increases, the call option price increases and the put option price decreases. And we would explain this with the help of an example. If the current market price of a PTCL stock is rupees 40 instead of 30, the strike price, imagine, is 30. The value of option would be 40 minus 30. That is, the value would be 30. So imagine it is a call option. How do we find the value of call option? It is ST minus K. Right. So if the future spot price or the stock price at the expiration is higher, so in this case we have a strike price of 30, then this option would have a value of 10. imagine if this future spot price was lesser, it was 35 rather than 40, then the value of this call option would have been 5. So that means as the future spot price increases or the stock price increases, the value of the call option increases, and the opposite happens to the value of put option. So as stock price increases, the call option would have a higher premium. This is our third determinant. Moving towards the fourth determinant, which is the variability in the underlying asset. And by variability we mean the price of assets are volatile. They increase and decrease quite a lot. There is high variability in the prices. There is high volatility in the prices. There is high dispersion in the prices. So when that happens, what would happen to the value of option? The greater the variability or volatility in this value of the stock, in the price of the stock, we are talking about the underlying asset, the more valuable the call option will be. And the greater variable can subject the option writer, the opposite party, to higher loss. This is why option writer will need higher premium to give such option. So the idea is, then when there is a higher variability in the prices, so imagine there is a stock, again the PT cell stock, and we know this PT cell stocks increases and decreases quite a lot. There is a high variability in the price of the stock. Then someone selling the right of this PT cell stock, that means the option writer, because he knows there is a higher risk, there is a higher chance of losing money, what this option writer would do, he would demand a higher premium for this higher risk, whether it is a call option or a put option. The higher the variability, the higher the standard deviation, the higher the variance, the higher the volatility, the higher would be the risk and the higher would be the premium. And the last determinant is the interest rate, and this one is quite interesting. The buyer of call do not pay the exercise price until they exercise the option. And what does this mean is that, let's imagine there is a call option with a premium of 5 and a strike price of 1000. This is K. When would this premium be paid? This would be paid at the time of entry into the contract. And this 1000, the whole amount would be paid at the expiration. Now, this would not be paid at this time period, at zero time period today. So what this call option holder can do is invest this $1,000 for this whole time period. Let's say he can deposit in some bank account and earn an interest. Now you get an idea that interest is a factor. So when the interest rates are higher, the call option holder can earn higher interest on the amount that he had deposited in the bank account. Because the buyer of the call do not pay the exercise price until they exercise the option, so this amount can be invested. So the ability to delay payment is more valuable. This ability of the call option holder to delay payment, I mean, this payment is delayed, right, is more valuable when the interest rates are higher and less valuable when interest rates are lower. So when interest rate would increase, the value of call option would increase, and the premium of call option would also increase. So there is a positive relationship between interest rate and the value or the premium of the call option. What about the value of the put option? Okay, So in put option, the premium was again paid at this time period, but instead of keeping the amount, the person would receive the amount, the option holder would receive the amount at this time period. So if interest rate increases, this put option holder loses the opportunity to earn higher interest on this amount because he had not received this amount, because in put option, if you remember long put, the put option holder is selling the asset, the premium is paid at this time period, and the sale or the transaction would be fulfilled at the maturity, and the amount would be received on maturity. So the put option holder cannot exploit from the increase, cannot earn higher interest, or cannot take the opportunity of earning higher interest because he do not have received the amount. So when the interest rate increases, the value of call option increases, the premium of call option increases, but the value of put option decreases and the premium of put option decreases. And let me summarize this whole. We first discussed the exercise price. There was a negative relationship between exercise price and the value of call option, a positive relationship between exercise price and the value of put option. In case of share price, there was a positive relationship between share price and the value of call option, and a negative relationship between the share price and the value of put option. Time of expiry and volatility both had similar effect on put and call option, whereas interest had a positive impact on call option. The higher the interest, the higher would be the value of call option, but a negative impact on the value of put option. So based on these factors, there is a model which is called a Black-Scholes model. So this model was developed by three researchers, Black, Scholes and Merton, and they got a Nobel Prize for this model. This model was developed in 1973. So from this Nobel Prize, you can get an idea that it is an important model. And this is how the model looked like. We have two equations, one for the premium of the call option and the second for the premium of the put option. So the call option premium is equal to S, which is spot price, into ND1. We are going to understand what ND1 means, minus the exercise price into e raised to power minus RT into ND2. ND1 would be calculated using this equation, which is D1 is equal to natural log of S by E, spot price by exercise price, plus the risk-free rate, the sigma square divided by 2 into T. So just to give you an idea, we are going to discuss this model in detail in next slide. But just to give you an idea that we have S naught, which is stock price. You remember the stock price is one of the element, one of the determinant, one of the factors used to find the value of the stock. This is exercise price. This again is a determinant. Then we have risk-free rate, which is interest rate, again a determinant. This sigma square, if you understand, it stands for variance. And variance is used to calculate the volatility, dispersion, variability, and which was again a determinant. Time is a determinant, maturity, time to maturity. So you can get an idea that all those factors that we just discussed are important to calculate, to estimate the value of a call or a put option, are incorporated in this model, which were missing in the put call parity model. So in next lecture, what we are going to do is we are going to understand this model, and we are going to use this model to find the premium of the call and the put option.